On every single trading day, Apple stock changes hands 50 million times, one transaction every 1.7 milliseconds. Buyers and sellers agreeing on a price, then immediately disagreeing on it again. And yet most people have no idea who sets that price or why it moves the way it does. That question is exactly what this video answers. I'm Grace, and by the end of this, stock prices will never look random to you again. Here is exactly what we're covering today. First, the order book, the live engine behind every price tick that most beginners never learn about. Second, what a stock is actually worth. 4 methods investors use to value a company, explained simply with real numbers. Third, why prices go haywire. Sentiment, speculation, GameStop, Tesla, and why rational investors sometimes get crushed anyway. And fourth, the external forces that move prices in ways that have nothing to do with the company itself. Let's get into it. Here is the simplest way to understand stock pricing. The stock market is a farmer's market. Sellers shout what they will accept, buyers shout what they will pay. And when 2 people agree, a deal is done. The price of that deal becomes the price everyone sees. Every stock has something called an order book, a live, constantly updating list of every pending buy and sell order in the market. On the left, buyers, called bidders, each stating the maximum price they are willing to pay. On the right, sellers, called the ask side, each naming the minimum price they will accept. The highest bid and the lowest ask sit right next to each other. The gap between them is called the spread. When a buyer's bid matches or beats a seller's ask, a trade executes instantly. Both orders vanish from the book, and that agreed price becomes the new stock price. That is all the stock price ever is, the price of the most recent completed trade between a willing buyer and a willing seller. Nobody sets it from above. No committee decides it. It emerges from millions of individual decisions, every millisecond of every trading day. Here is what makes Apple different from a tiny stock. Apple's bid-ask spread, that gap between buyers and sellers, is typically 1 penny, 1 cent on a $200 stock. That is 0.004%. For a small cap company with less trading volume, the spread can be 50 cents or more. That spread is a real cost you pay every time you trade. For Apple investors, it is essentially invisible. For penny stock traders, it quietly eats their returns on every single transaction.
Now, here is the insight that ties everything together. Every single factor that moves a stock, earnings reports, interest rates, breaking news, CEO tweets, works through exactly one mechanism: supply and demand. More buyers than sellers, buyers compete, bidding prices up. More sellers than buyers, sellers compete, cutting prices to find a taker. Understanding this is not just trivia. It is the lens through which every other concept in investing makes sense. So let's now ask the deeper question. What actually determines whether there are more buyers or sellers? And the answer starts with a company's true worth.
When you look up a stock price, you're seeing what the market is willing to pay for the stock right now, but that is not the same as what the company is actually worth. Investors call that true worth the intrinsic value, an estimate of a business's real value based on its earnings, cash flow, assets, and growth potential. Think of it like buying a house. The listing price is what the seller hopes to get. The intrinsic value is what the house is actually worth, based on the neighborhood, comparable sales, and rental income potential. Smart investors calculate intrinsic value first, then look for a market price that offers a discount. We call that margin of safety. There are 4 main methods to estimate it, and each one looks at a company from a different angle. Method 1 is discounted cash flow, or DCF. It asks a deceptively simple question: what is future money worth to me today? The answer is always less than the same money today, because money today can be invested and grown. Here is how it works with a simple example. Imagine a lemonade stand that earns $1,000 in profit every year. Someone wants to sell it to you for $5,000. You want at least a 10% return on any investment. So you discount each future year's earnings back to today. Year one's $1,000 is worth $909 today. Year 2 is $826, and so on. Add it all up, and you decide the stand is worth roughly $3,790 to you at a 10% return. If the seller is asking $5,000, that is too expensive. If they drop to $3,000, it is a deal. This is literally what Wall Street analysts do with Apple and Nvidia, just with billions of dollars and far more assumptions. The big caveat: a tiny change in your assumed growth rate swings the valuation enormously. DCF is a framework, not a crystal ball. Method 2 is the dividend discount model, a simpler version of DCF designed for companies that regularly pay dividends to shareholders. The idea is straightforward. If a company pays you $2 per year per share, growing 4% annually, and you require a 10% return, the stock is worth about $33 per share today. This works beautifully for stable dividend payers: utility companies, consumer staples, banks. Coca-Cola, for example, has raised its dividend for 62 consecutive years. But the DDM is useless for Amazon, Tesla, or any company that reinvests its profits instead of paying them out. Method 3 is asset-based valuation. Add up everything a company owns: buildings, equipment, cash, inventory, then subtract everything it owns. What remains is the asset value. Think of selling a restaurant. The building plus kitchen equipment plus inventory minus the bank loan equals what you are really getting. This method works well for real estate companies, banks, and manufacturers with lots of physical assets. Its big blind spot: it completely ignores future earning power and intangible assets. Apple's brand alone is worth hundreds of billions of dollars. None of that shows up on a balance sheet. Method 4 is the one you will see referenced most often: the price-to-earnings ratio, or PE. It simply asks how many years of current profits would it take to pay back today's stock price. A PE of 30 means investors are paying $30 for every $1 of annual earnings. Here is where it gets fascinating. Tesla currently trades at roughly 322 times earnings. General Motors trades at 5 to 8 times earnings. Both make cars. The PE gap between them is about 40 times. Why? Because investors are not pricing what Tesla earns today. They are pricing what they believe Tesla could become: autonomous taxis, humanoid robots, AI infrastructure. GM is priced as a mature business. Tesla is priced as a bet on the future. Neither multiple is objectively right or wrong. They simply reflect what millions of investors collectively believe, and those beliefs can be very, very wrong, or surprisingly correct. The investor most associated with intrinsic value is Warren Buffett. His approach is deceptively simple: calculate what a company is actually worth, buy it when the price offers a significant discount, and hold it for decades. He calls that discount the margin of safety. His analogy: when you build a bridge designed to carry 30,000 pounds, you only drive 10,000-pound trucks across it. That buffer protects you when your calculations are off, and they will sometimes be off. Here is where many beginners get confused. Intrinsic value does not always explain the price you see on your screen, and that is not necessarily a mistake. Value investors like Buffett focus on what a company earns today. Growth investors focus on what a company could earn 10 years from now. When the market gets excited about a sector, think AI, biotech, cannabis, it will pay prices that look wildly disconnected from current earnings. That is not irrational on its face. The question is whether the excitement about the future turns out to be justified. Sometimes it does. Sometimes it spectacularly does not. Nvidia is the most instructive stock story of the past 3 years. In early 2023, the stock was around $15 per share. As AI demand for its chips exploded, investors bid the stock up to over $200, a gain of more than 1,400%. In April of 2023, Nvidia's PE ratio hit 139 times earnings. That looked like pure speculation. But here's the twist. Nvidia's revenue went from roughly $27 billion in 2023 to a projected $147 billion by 2026. Earnings grew even faster than the stock price. By early 2026, despite the massive stock gain, Nvidia's PE had actually fallen to 35 times earnings, below its 10-year average. Nvidia is the rare case where the narrative was backed by real numbers. The lesson: high prices are not automatically wrong. but you need the fundamentals to eventually show up. Now, contrast that with Tesla, PE of roughly 322 times earnings against an auto industry median of around 19 times. Meanwhile, Tesla's revenue actually declined over the past 4 quarters. The market is not pricing the car company. It is pricing the belief that Tesla will dominate autonomous taxis, humanoid robots, and AI infrastructure. That might be right. It might not. Either way, it means Tesla's stock price is almost entirely a function of what investors believe about the future, and beliefs can change very fast. In January 2021, GameStop was a declining brick-and-mortar video game retailer. Hedge funds had shorted more than 140% of its public float, meaning more shares were short than even existed. Then, Reddit's Wall Street Bets community coordinated a mass buying campaign. The stock went from $20 to $483 in roughly 2 weeks. Keith Gill, a 34-year-old financial analyst, turned a $53,000 options position into $48 million. Hedge fund Melvin Capital lost 53% in a single month and needed a $2.75 billion emergency bailout. This was not about GameStop's business. It was a weaponized short squeeze, demand manufactured by collective behavior, detached from fundamentals. The stock eventually crashed back toward reality, but not before rewriting the rulebook on how markets can be moved. Cannabis company Tilray is the textbook supply and demand bubble. It IPO'd in July 2018 at $17 per share, the first cannabis company on a major U.S. exchange. 2 months later, with only 17 million shares in the public float and massive speculative interest, the stock hit $300 intraday. At its peak, Tilray had a market cap of $27.6 billion on just $40 million in annual revenue. That is a 405 times revenue multiple. Today, Tilray trades around $6.70, down 97% from peak, unprofitable, and facing a NASDAQ delisting warning. The product did not change. The company did not change much. What changed was the supply of shares and the temperature of investor enthusiasm. Law of supply and demand, undefeated. There is a saying every investor eventually learns the hard way. The market can remain irrational longer than you can remain solvent. You can be completely right about a company's fundamentals and still lose everything simply because the market is not ready to agree with you yet. Timing the market is not just difficult, it can be financially fatal. The dot-com bubble ran from 1995 to 2000, 5 full years of escalating irrationality. The NASDAQ rose 600%. Companies with no revenue hit billion-dollar valuations. Pets.com raised $300 million and went bankrupt 9 months after its IPO. VerticalNet reached a $1.6 billion market cap on $3.6 million in quarterly revenue. And yet, anyone who correctly identified the bubble in 1997 and shorted these stocks would have been financially destroyed by 1999, 3 years too early. The market stayed wrong longer than rational analysis could withstand. Then, in March 2000, the bubble burst. The NASDAQ fell 78% over the next 2.5 years, wiping out $5 trillion. The lesson is not that bubbles always burst quickly. The lesson is that the timing is nearly impossible to predict, and that being right about the fundamentals does not protect you from the market's mood.
And if you think 5 years of irrationality is impressive, Japan's asset bubble makes .com look restrained. The Nikkei 225 peaked on December 29, 1989. Fishery stocks were trading at 319 times earnings. Tokyo real estate was priced at 350 times Manhattan. Then, the bubble burst. The Nikkei did not surpass that 1989 peak until February 2024, 34 years to break even. Investors who bought at the top waited over 3 decades just to recover their original investment. Now let's talk about the external forces that move prices, starting with the most powerful one of all, interest rates. The Federal Reserve sets the short-term interest rate, and that decision ripples through every stock in the market. Here is the logic. When rates are near zero, as they were through 2020 and 2021, bonds pay almost nothing, so investors flood into stocks in search of return, bidding prices up. When the Fed raises rates, bonds suddenly offer real income. Capital flows out of stocks and into bonds, compressing valuations. In 2022, the Fed raised rates 11 times, from near zero to 5.25%, the highest in 22 years. The result? The S&P 500 fell 19.4%. The Nasdaq fell 33%. Speculative growth funds collapsed by 60 to 70%. Higher rates hit future earnings-dependent growth stocks hardest because they make those distant future profits worth less in today's dollars.
Earnings reports are where the market's opinion meets the company's reality. Every quarter, companies report their actual revenue and profit. When results beat expectations, demand surges. When they miss, sellers flood the market. February 1st, 2024, Meta Platforms announced that net income had tripled to $14 billion in a single quarter. The stock jumped 20% in one day. The company added $197 billion in market value, the largest single-day gain for any stock in history. One earnings report, one day, $200 billion created or destroyed.
Government policy can move markets just as violently as earnings. In April 2025, the announcement of sweeping new trade tariffs triggered a 4.84% single-day drop in the S&P 500, the worst day since COVID. 7 weeks of cumulative selling followed. Then, on April 9th, when the tariffs were paused, the S&P 500 surged 9.52% in a single session, the largest one-day gain since 2008. Same companies, same earnings, completely different prices, driven entirely by policy news. This is why experienced investors learn to separate short-term price noise from long-term business fundamentals. Beyond fundamentals and sentiment, there is a third approach to understanding stock prices: technical analysis. Rather than asking what a company is worth, technical analysts ask, what do the price patterns tell us about where this stock is heading? A few core concepts. Trends. Prices tend to move in sustained directions, and the trend is your friend until it ends. Support and resistance. Certain price levels act as floors where buyers consistently step in, and ceilings where sellers emerge. And moving averages. The 50-day and 200-day simple moving averages are the most watched lines in all of finance. When the 50-day crosses above the 200-day, called a golden cross, traders consider it a bullish signal. The death cross, the reverse, signals weakness. Now, does technical analysis actually work? Honest answer, it depends who you ask and how you use it. Warren Buffett spent 8 years studying charts before rejecting them. Billionaire trader Paul Tudor Jones swears by them. Of 95 academic studies on technical analysis, 56 found statistically positive results, a slim majority. The most practical approach most professionals use: fundamentals tell you what to buy. Technical analysis helps you decide when. It is a timing tool, not a crystal ball. So, we have covered how prices are set, what they are based on, what distorts them, and what external forces drive them. Now for the most important question a beginner can ask: what does any of this mean for me as an investor? Benjamin Graham, the man who taught Warren Buffett, said this in 1934. In the short run, the market is a voting machine. In the long run, it is a weighing machine. What he meant: short-term prices are driven by emotion, narrative, and crowd behavior. Long-term prices are driven by actual business performance. The S&P 500 has returned approximately 10% per year on average since 1928. $10,000 invested in 1995 would be worth roughly $256,000 today. But the ride was brutal. Bear markets, crashes, recoveries. The index fell 19% in 2022. It rose 23% in 2024. Neither the crash nor the recovery felt rational in the moment. Both were completely normal in the long view. Here is the number that should change how every beginner thinks about market timing. JP Morgan studied returns in the S&P 500 from 2004 through 2023. If you stayed fully invested the entire time,
$10,000 grew to $64,844. If you missed just the 10 best trading days out of 5,000 total trading days, your ending value was cut nearly in half, $29,708. Miss the 30 best days, you end up with $11,701, barely more than you started with. And the most important detail, 7 of the 10 best trading days occurred within 15 days of the 10 worst days. The biggest rebounds happen immediately after the deepest crashes. You cannot capture the upside without enduring the downside. Let's bring it all together. 1. Stock prices are not set by anyone. They emerge from supply and demand second by second in a live auction between buyers and sellers. 2. Intrinsic value is what a company is actually worth based on fundamentals. Market price is what it costs right now. The gap between the two is where opportunities and risks live. 3. Sentiment, narrative, and herd behavior can keep prices irrational for months or years. .com lasted 5 years. Japan's bubble took 34 years to recover from. Being right about fundamentals does not protect you from bad timing. 4. External forces like interest rates, earnings reports, and policy news move prices constantly through the supply and demand mechanism every time. And 5. In the long run, the market is a weighing machine. Business performance is what determines lasting value. Short-term noise is just Mr. Market having a mood. If you found this useful, drop a comment with the one concept that surprised you most. I am genuinely curious. And if you want more videos like this one, subscribing is the best way to make that happen. Thanks for being here.